Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Dave Erfle, founder and editor of the Junior Miner Junky. Now, Dave, let's focus on the precious metals stock charts, more so the ETFs like GDX, GDXJ here initially, simply because, look, GDX was doing pretty well since that low in October, very beginning of October. We were seeing consecutive higher highs and higher lows as it was digging its way out of that sell off, or at least a pullback through most of 2023. But in the last couple of days, we've seen some higher volume days and some gaps to the downside. And now, well, one of the most recent higher lows has now been exceeded to the downside. In terms of chart levels that you are watching for GDX initially here, and I guess we need to talk about downside chart levels. Where are you looking for here, Dave?
Yeah, Corey, going into the end of the year, the gold stocks were getting a little overbought, and those gaps down in the GDX and GDXJ that were created in November, those upside gaps are now looming. We're looming more like, hey, those looks like those things are probably going to fill because the silver price and gold stocks, ever since the end of 2023, began to show relative weakness to the gold price, meaning they were leading the gold price lower. So whenever you have silver and the miners generally lead the gold price in both directions. When they start to show relative strength to the gold price, you can pretty much guarantee that we're going to have a nice run in the sector. And it's the other way around as far as the downside is concerned. So if we take a look at where they're trading at right now, those gaps from November on in GDX, the gap is at around 32. In GDXJ, the gap is at around 32.50, and in GDX, the gap is at around 26.50, and that's about 2% lower from here, which will probably fill tomorrow. I mean, you take a look at what's happening today. You've got a nice pop in the gold price. Silver's still showing relative weakness, but the pop is coming from for geopolitical reasons. You see the Palestine attack on Iran, so that is not being reflected in the miners or the silver price. So that's telling me that, hey, that gap's probably going to be filled either Friday or early next week. And then as far as the downside's concerned, another another level to look at is the October lows in both GDX and GDXJ, which is 6% lower. But in the short term, both are extreme oversold here. So we're either going to see a bounce pretty soon, and that'll be the bottom, or we're going to see a bounce and then the October lows tested, which are about 6% lower than they are from where they're trading right now in both GDX and GDXJ.
Well, Dave, when looking at GDX, if we widen the scope back to a larger chart or a longer term chart, we were talking about this off mic, and I just thought it'd be fun to discuss again here. And that is that when you look at where things actually bottomed in GDX, when gold bottomed back in the end of 2015 and the early 2016, GDX got all the way down to 1146. So we're twice as big above that now as we were then. And yet it seems like the mood still feels like everybody feels we're in a bearish market and have been, it seems like for a decade. But when you look at what happened, after 2016, it raced up to 30, let's say, it shot back down to 16, got up to 40, shot, there was the pandemic crash. But it's been making a series of lower highs, even though the gold price has been level. It keeps bouncing like a ball lower and lower and lower, but it's still nowhere close to the 2016 lows. How would you talk to somebody that's looking at the sector, GDX or GDXJ, from a longer term perspective? Are we in a bear market? Are we in a bull market? Are we in a sideways market? Where in the world are we in the big picture?
Well, as far as the miners are concerned, right, in the GDX and GDXJ, because GDXJ is basically mid tiers with some majors, and GDX, of course, is the majors. So as far as the miners are concerned, they have stuck to the 7-year cycle low pattern, which began at the turn of the century, right? In 2001, you had a major low in the miners. In 2008, you had a major low in the miners, and then late 2015 to that early 2016, you had a major low in the miners. That was 7 years later, and then 7 years later, in September of 2022, you had a major low in the miners. But the juniors are a different story. They continue to go lower. And if you take a look at the GDX in relation to the venture exchange more recently, the juniors have been outperforming since the capitulation tax loss selling low of mid-December. But that is not a very good barometer either, because it's only about 50% junior. So you want to get a real junior barometer, you basically have to construct your own junior ETF, which is basically what I have done for myself and my subscribers. But as far as the miners are concerned, yes, they are technically in a bull market because they've been consistently making higher highs and higher lows since that major low in 2016. You take a look at it, it's a nice uptrend channel. So they're still in a bull market, while the juniors remain in a bear market, while you've had several success stories within this bear market. I mean, let's face it, the juniors have been in a bear market since late 2012, early 2013. We've had a couple of nice 6-month runs where you had 5-10 times gains in some quality juniors. You've had some takeouts with on a few companies. Great Bear Resources was a nice success story. Silvercrest was a nice success story. We've had several of them, but as a whole, the juniors have been in a bear market for the past decade. And the reason why they've been in a bear market for the past decade is because the generalist investor who came into the sector back in 2001, they left in late 2012, 2013, when the gold price lost strong support at 1550, and they haven't returned. So if you take a look at the gold price, it made a major bottom in 2000. It double bottomed in 2001 on the back of Alan Greenspan coming into the marketplace and lowering interest rates by 50 basis points. That's what started the bull market in gold, and that lasted for a decade, right? So now we've got the gold price, flirting with new highs above 2000, where back in 2016, gold was flirting with new lows below 1,000. That didn't happen, and that started the new bull market in the miners. Now we just waiting for the next phase in the mining stocks, in the next bull phase in the mining stocks, which I believe will begin once the gold price has a monthly close above 2,100, which will solidify I believe will solidify the floor at 2,000 that it's been trying to create here for the past several months.
Dave, don't we need gold to go even much higher than 21, 22, even 2,500? Because the last two major moves in the stocks and in the overall sector have been multiple moves for the gold price, averaging 6 to 7 times higher gold prices over longer time periods. To Shad's point, you look at that long-term chart of GDX, and it's actually lower highs since 2011 and the peak that we saw there. It just hasn't had the torque as we've seen other sectors move higher, provide much better gains for investors. Do you think gold could get up to 3,000, 4,000, 5,000, start to tack on these price levels that seem like that truly would bring in way more investors?
Well, I like to focus more on what's directly ahead of me, and I think what's directly ahead of us is the 2,500 level. I think that's because that's what the technical target is after the gold price makes a monthly close above 2,100. That would be the cup and handle target. Because we've had a 13-year cup and handle on the gold price now. The cup being from end of 2011 to the middle of 2020. So it's like almost a decade long cup, and the handle has been like 3 years now. So it's a very bullish setup, but we need that technical close, monthly close above 2,100 for that to be in place. And then the measured move from there would be the 2,500 level. And that would definitely get the juices flowing, not only in the miners, but in the juniors. and we've got this Fed pivot that we know is going to happen eventually. The Fed's done raising interest rates, no matter how much they jawbone about keeping them higher for longer. They've already laid out a roadmap for rate cuts. So when that pivot happens, the last three times we've had a pivot, from 2000 to 2008, the mining sector went up 400%. And from January of 2016, that we were just talking about, until August of 2016, the mining sector went up 238%. And then the most recent one was the COVID low in March of 2020. And that was just a 5-month run into July of 2020. And that was a move of over 200%. So we know this move is coming. We just don't know when it's going to start, which is, basically benefits anybody who's accumulating right now and has the cash to do so and the time to pick out the correct stocks to accumulate and hold until this takes place.
Well, Dave, just one more question more on the fundamental side of the mining stocks, and that is we're getting ready to go to the conferences here in the next couple of days. We're going to have the Metals Investor Forum. We're going to have Roundup. We're going to have the Vancouver Resource Investor Conference. So 3 big conferences in a row, bam, bam, bam. A lot of times this is the kickoff for the season, but what concerns me is what we've been talking about lately in the last few discussions with you, the lack of overall news in the sector. And I think that ties to a lack of overall funding in the sector. Like when you look at what happened over the last, let's say, 12 to 18 months, the companies that put out good news, it was shrugged off. The companies that moved the ball down the field like they said they would, doing their drill program or putting out assays or putting out a resource or putting out an economic study, almost all of that was shrugged off or sold off, which is kind of a bearish action in the sentiment. Why would that change in 2024? Why will people start caring about news again? Are any of these companies even going to have any money to put out news this year?
Well, the good companies, the quality companies, are getting funded. Those projects, the high margin projects in good jurisdictions that are multi-million ounce projects that with blue sky potential, and with the solid management teams that know when to raise capital and more importantly have the access to capital. That's continuing to happen, even though their share prices are continuing to lag the mining sector, the miners. So bottom line is, Chad, a lot of these companies that are having trouble getting financed, they need to go away, and it's just not happening. Because basically, most of these exploration companies that have made discoveries on smaller land packages, or the discoveries just aren't very attractive. They continue to try to move forward and de-risk lower margin projects or lower quality projects, thinking or hoping or advertising that they're going to get bought out by a major. Well, it's just not going to happen. So a lot of these companies still need to go away, and many of them will be forced to either go away or merge with other ones. We're still seeing, a lot of merger of equals happening. That needs to continue because there's only so many checks that these banks can write for these companies. So that's the one thing that we touched upon. I think it was last week or the week before, that this is a great time to be concentrating on these quality companies that are doing good work, and those are the ones you invest in. And that's the great thing about a market like this, is the really quality ones are standing out. Those are the ones that you can trust, that they're doing the right things. They're de-risking high margin projects, and they have great management teams, and they're raising money at the right times, and they're making good progress on permitting. That's a major thing. And it looks like that they have a shot of being bought out by a major eventually. But you don't want them to get bought out too soon, because while you're accumulating them, you could be down 20-30% on them. And then if they get taken over too soon, you're only going to get maybe your money back, or maybe even a double if you're lucky. And that's not why we invest in these things. We want at least 3 to 5 times upside potential from where we're accumulating these stocks from our average cost eventually within the next 3 to 5 years. So That's the great thing about a market like this is you can concentrate on companies like that, but you have to have a lot of patience and you have to have a cash account and you shouldn't be trading on margin.
Oh, it's definitely still a stock picker's market. You are right, Dave. And there are good companies out there that have cash, continuing to do their work, and a lot of other companies that don't. So, yeah, do your homework, pay attention to those good companies, and again, have that time frame too that might not return it to you right away, but at least some of them can a bit weather that downside too. Dave, thank you as always for your time, man. We will chat with you again next week. Who knows what we'll talk about in this market? Who knows if we'll even see some of those lower gaps filled that you shared with us, but we will follow up on those. Thanks for your time, Dave. Have a great rest of your week.
Thank you guys. You too.